All right, let's take this to the next step. Let's just say we want to file an extension, but we want to do so and avoid any type of penalty or interest or any additional expense that we just went through. So you can say, hey, I don't want to pay that 14%. I want to figure out so I can pay whatever the estimated correct payment is on April 15th. Now, what we have is we have some time. So you as a business owner have from January 1st to March 15th to kind of figure out this is what's gone on in my business. And really, if we're going to take this to the simplest level, we can make a simple case or more complex case, but let's take it to the simplest level. From your business, you take personal cash flow, you have cash in your business checking account or your business investment account, and then you may have debt. Those are the three things. That is your cash flow and balance sheet right there. And how this would break down. Let's say that you are married, filing jointly, and from your business, you take $150,000. And from that $150,000, after all the deductions and the kids and everything like that, you owe the federal government $20,000. So don't get too tied into those numbers. I just want to keep these examples simple. I know that this year I'm going to have $20,000 of taxes owed because I am paying myself $150,000. It's going straight from my business over to my personal account, which is non-deductible. Now let's just take a look at what happened with the balance sheet, because you have all the business revenue going into your business checking account. This is why they say, let's see how things balance out. January 1st, if the balance is $10,000, we had money coming into the business account that's paying for all the business expenses. If all the business expenses are qualified business expenses that are deductible, then they are not going to be taxed. Now it comes December 31st, our balance is $20,000. In this case, we have $10,000 additional revenue from the business that hasn't gone to the personal, because that dollars has already left my business account, and it hasn't gone through any type of business expense. So simplistically looking at that, you would say, you know what, I made another $10,000 in my checking account. It's more than it was by $10,000. Now, if you have debt, say you have $10,000 of debt, now it balances out because you have $20,000 in a checking account. It's $10,000. Subtract the debt, it's $10,000, the same amount that you had come in. In that particular case, that things worked exactly as you thought they were going to. As you paid yourself the $150, just say you had $500,000 of business expense that all got taken out of your business account, and you're left with another $10,000 at the end, $10,000 net at the end of the year. So just simply looking at those three things in a very simple business, that's how it works. Some things that could cause problems with the balancing of your books. Number one is if you have a large cash expense. So let's just say you took $100,000 from your business account and went to go pay off something like a hard asset. Like you bought something in your business that's a big piece of machinery or something that costs $100,000. That machinery may not allow you to have a full deductibility, meaning it may say you have to amortize or depreciate this over the next 5 years, something like that. So that example is $100,000 left your business account, but you're only able to deduct 1/5 of it, like in my example. So that's one area that you got to be careful of to understand. First off, what's the best way to pay for a piece of machinery? Second is that I'm going to still have to pay taxes this year on 4/5 of the expense of that piece of machinery. So that's where you just have to dig a little bit deeper. It may not be a case of this is one example on how some complexity could come into this calculation. The other, which for smaller businesses could be more, is that you're using your business checking account for personal expenses. So then what happens is like, well, I only got $10,000 left. Well, you actually didn't just use $150 for personal, you used $150 plus all those personal expenses, which are non-deductible. So those are two ways that you can get into trouble with thinking that you're only going to owe so much, but you actually end up owing a lot more. Thinking about it in the simplest form is that your dollars, if they're not going to a deductible expense of your business, that's dollar for dollar, then you're going to have to pay taxes on it. And the best way to look at it is like, well, what do I have in my accounts? And how much did I take out personally? Then you can make a calculation.